The tone of the housing market is starting to change, and we're starting to see articles like the recent one from CNN talking about a potential housing bubble. We've also recently heard from the Federal Reserve their plans for 2022, which will have a significant impact on the future of the housing market. And to make matters more interesting, lumber just shot up over 2.5 times what it was just back in September alone, which is really starting to cause some affordability issues with building new houses. Add to that inflation hitting an almost 40-year high and continued supply chain issues, and there's growing concern about what this could all mean for the future of the housing market. What's up, guys? It's James Allen, the Out-of-State Investor, and today I'm going to share with you the latest news on the housing market about what could potentially cause the housing market to flip in 2022. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, you gotta subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Last month, inflation reportedly hit the highest level since June of 1982, and because of that, everyone's been waiting to see what the Federal Reserve is going to do in response. You see, for the past several months, bringing us all the way back to the start of the pandemic, the Federal Reserve has been purchasing about $120 billion every single month of treasury bonds and mortgage-backed securities, which in turn has brought us to experience the lowest mortgage rates that we've ever experienced. Now, the Fed originally made plans to completely stop these purchases by June of 2022, but with inflation hitting a 31-year high in October and an almost 40-year high in November, everyone's been watching to see what the Federal Reserve will do in their December meeting. Well, that meeting recently took place, and they ended up making some major adjustments to their plans for 2022, which in turn will have a serious effect on the housing market. Now, in general, the central bank sees progress on vaccinations, they're seeing solid job gains and improvements in the sectors that were most severely affected by the pandemic. Add to that the crazy inflation that we've been experiencing, and there's a lot of motivation for the Fed to speed up their original plans of tapering their treasury bonds and mortgage-backed securities. And in fact, that's actually exactly what they plan to do. So first things first, they announced that starting in January, they're going to be doubling the speed of the tapering of these treasury bonds and mortgage-backed securities, which means that instead of the original target of June 2022, we're going to be at March 2022 by the time they completely stop purchasing these assets. Now, the reason we care about this is because mortgage interest rates are almost directly connected to the purchases of these treasury bonds and these mortgage-backed securities. And so if you're dropping the amount by $120 billion a month, it's bound to have an effect on mortgage interest rates, which is why so many economists are expecting for mortgage interest rates to go up in 2022. Now, that's mortgage interest rates. They also plan to raise the federal funds rate 3 different times next year, with the possibility of even a 4th. So the reason we care about what the federal funds rate does is it really affects a lot of consumer borrowing, things like personal loans, things like HELOCs, even adjustable rate mortgages. So in general, it makes borrowing money more expensive, and it also slows down the economy, but what it does do is it helps fight inflation, which right now it seems that is the #1 priority for the Fed. Now, with that said, the Fed did decide that they're going to keep the Fed funds rate at 0% for now, with the possibility of the first rate increase taking place in March of 2022. Now, going back to mortgage rates, many experts predict that although mortgage rates are expected to hit the high 3s, low 4s by next year, at the same time they're expecting mortgage lenders to start to loosen up their underwriting standards. Now, a big reason why they're expecting this to happen is over the last year we've been experiencing these all-time low mortgage interest rates, and because of that, there's been massive demand from homeowners wanting to refinance their home. Well, with rates going back up again, there's going to be less and less demand for refinances. We're already starting to see that, and as a result, there's going to be more of a focus towards home buyers. Now, the problem with that is with interest rates likely to go up in 2022, it's likely to have a negative effect on the demand side of things, with home buyers facing a more unaffordable situation. So the way the lenders can resolve this issue is they can simply lower their underwriting standards, which then makes it easier for people to qualify for a house, which helps increase the demand. Now, this could mean potentially that those who are self-employed or those who work in the gig economy might have a better chance to qualify for a a house, depending on what the lenders end up implementing. But it's not just interest rates that can make things more expensive for the everyday buyer. Right now we have a serious housing shortage, which continues to push prices up every single month. In fact, Redfin just came out with an article that we just hit a new low of housing supply, which is not good news for people trying to get in the market. And in addition to that, that has contributed to this 15% year-over-year growth we've seen nationwide, which is actually the 16th month in a row of double-digit growth. Now, the amount of homes sold in the last year has actually gone down 5.8% year-over-year, which sounds like the housing market is slowing down, but that can actually be a bit misleading. You see, new listings have also gone down 8.7%, so it's natural to expect that if you have less listings, you're going to have less sales as well. So on one hand, we have this booming housing market with this extremely low housing supply that just continues to go down and doesn't seem to be slowing down anytime soon. Now, on the other hand, we have the Fed that's making moves that would counteract this growth by raising interest rates across the board. So what does this mean for the housing market? Well, on one hand, if you're wondering if a crash is going to happen, I really don't believe a crash is headed for 2022. Now, do I have a crystal ball? Absolutely not. But what I do see is I see what's taking place in front of our eyes. With an all-time low inventory, we can't possibly see a housing crash unless the supply goes much higher. And that just isn't going to change just because interest rates going up maybe 1% higher. What I do see happening though is I do see things starting to slow down as far as price growth is concerned. I don't think we're going to have anything close to what we experienced in this year of 2021. So I do think price growth will slow down, especially with interest rates rising. The better question yet is how much is it going to slow down? So what I want to look at as we head into 2022 is what do lenders continue to do to incentivize buyers once these interest rates start to go up? Now, if lenders started to get back to the flexibility they had back in 2007 when they were handing out loans to pretty much everybody, yes, that would be a big problem for the housing market and it would likely cause a crash. But fortunately, we're not at that point right now, so there's no need to sound any alarm, but it's definitely something we want to definitely keep an eye on. So with that said, that is the latest going on with the housing market. Definitely a lot of things we want to keep a close eye on. We got interest rates, we got this housing supply shortage, so many things to keep an eye on as we go into 2022. But with that said, if you found today's video helpful and you gained any value at all, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, do me a favor, let me know in the comments, do you like this type of content? Do you want me to do more of this content and continue to keep you guys updated with this stuff? Let me know in the comments below. Finally, make sure to follow me on TikTok and Instagram at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.